businesses that will perform the best are the ones that require little capital investment to facilitate inflationary growth and that have strong positions that allow them to increase prices with inflation. And we have a candy business, for example, and value of the dollar since we bought that candy business has probably fallen at least 85%, I would say, 80 to 85%. And that candy business sells 75% more pounds of candy than it did when we bought it, but it has 10 times the revenues, and it doesn't take a lot more capital. So that kind of a business, any business that has enough freedom to price to offset inflation and doesn't require commensurate huge investment to support it, will do well. Businesses like our utilities, which get in effect a bond-like return, but require, if you're going to build a generating plant, it costs twice as much per kilowatt hour of capacity, and all you're going to get is a fixed return, and yields on bonds go up, perhaps dramatically if you get high inflation, is not going to do that well in an inflationary period, just because it has certain aspects of a bond-like investment, and bonds generally are not going to do well in inflation. Charlie?
Well, but like our insurance operations, our capital-intensive railroad business is certainly one of the best railroads in the world, and our utility operations are certainly one of the best utility operations in the world. And so it isn't all bad to be up there world class in your main businesses.
Our railroad, the government's talked about building a high-speed rail system in California. I think they're talking about 800 miles of track, and their estimated cost was about $43 billion. And estimated costs on constructions of things like that go up dramatically, much more often than they get reduced even by a minor amount. And of course, we paid $43 billion, counting debt assumed, for a rail system which has 22,000 miles of main track and 6,000 plus locomotives and 13,000 bridges if you ever want to buy a bridge. So the replacement value of that asset during inflationary already is huge, and it would grow dramatically, and our country will always need rail transportation. So it is a terrific asset to own. I'll just leave it at that.
Inflation was much stronger in January than it's been in recent months, both headline and core. Used car prices remain high, and they've started to increase again. Home prices have been declining slowly, but they still remain elevated. Any easing of home prices or rents will not have an impact on inflation data in the short term, though, due to the way the shelter inflation is calculated. There seems to be an expectation that the housing market will bounce back, supporting a strong economy. But this is unreasonable, as recent labor markets and inflation data indicates that mortgage rates have little room to move downwards. The federal debt continues to increase and is now at over $31.57 trillion. With the feds raising interest rates, the cost of servicing the debt may rise to $800 billion for the year. With a rise in the debt ceiling, which is to be expected, the cost of servicing the debt in 2024 may well be over $1 trillion. A problem for the Treasury is where the money will be found to pay the interest on the debt, as tax revenue's not sufficient to do so. Investors should reckon that high inflation is going to continue for several years. The Fed will probably bring on a recession with its higher interest rates, and that should produce the Fed pivot, which means that the Fed will give up the fight against inflation by continuing to keep basic interest rates at 5% or higher. A recession will mean less tax revenue for the Treasury, which will already be struggling to service the debt that only continues to increase. The CBO, or Congressional Budget Office, forecasts are not at all encouraging, so it's highly likely that inflation will continue to remain high. A 5% portfolio allocation of physical gold is reasonable. 10% in physical gold would be considered an upper limit. Holding cash in an inflationary environment is not advisable, and therefore cash holdings should be kept to a minimum. Bonds are a sure way to decrease one's wealth when inflation's high. That is, when inflation is higher than the interest on the bond. Bond holdings should consequently be lower than the traditional 40% of the portfolio. The stock market will probably not do well in a severe recession, which can be expected if the Fed keeps interest rates high for much longer. It is therefore advisable to be extremely selective regarding stocks. Sectors that are likely to be recession resistant are to be favored. Healthcare and energy could suffer less. A traditional sector that usually does well in an inflationary environment is real estate. There are, however, certain problems that should be avoided. Commercial real estate is presently not doing well as companies are restricting the amount of office space that they require. Shopping malls are also not doing well. The prices of single homes are falling due to high interest rates on mortgages. A much safer investment is residential rental properties. In this case, investors would do well to avoid buying apartments and managing them themselves. A much better move would be to invest in a REIT that concentrates on residential rental properties. Well-managed REITs usually pay good dividends. Since individuals cannot afford to buy a home due to high mortgage rates, the demand for rental accommodation will remain high, thus ensuring that REITs dealing with residential rental properties will do well.